Hey, what's up everyone? It's your boy OU7 back with another video. We're diving deep into the top 5 high-yield investment strategies for 2025. The financial landscape is changing faster than ever before. So, if you're ready to level up your financial game and make some serious moves in 2025, stick around. Buckle up, because we're about to get into it. Alright, let's kick things off with our first high-yield strategy: dividend growth stocks. These are not just any stocks. They are the backbone of a solid, long-term investment strategy. Essentially, dividends are like little bonuses that companies give back to their shareholders. It's a way for companies to share their profits with the people who invest in them. Dividend growth stocks take this concept a step further by consistently increasing those payouts year after year. This means that not only do you get regular dividends, but those dividends grow over time. The beauty of dividend growth stocks is that they offer a two-pronged approach to building wealth. You get the immediate benefit of dividend income and the long-term benefit of capital appreciation. First, you've got the steady stream of passive income coming in from those juicy dividends. This can be a reliable source of income, especially during retirement. Imagine having money deposited into your account every quarter like clockwork, without you having to lift a finger. It's like having a financial safety net that keeps getting stronger. On top of the income, dividend growth stocks also offer the potential for capital appreciation. As the company grows and its profits increase, the value of its stock tends to rise as well. As the company grows and its profits increase, the value of its stock tends to rise as well. This means your initial investment can grow significantly over time. So, not only are you collecting those sweet dividends, but your initial investment is also growing over time. It's a win-win situation for any investor. Now, I know what you're thinking. Graham, this all sounds great, but how do I find these magical dividend growth stocks? The answer lies in diligent research and analysis. Well, my friends, it's all about doing your research and identifying companies with a solid history of dividend growth. Look for companies that have a track record of increasing their dividends consistently. Look for companies that have been consistently increasing their dividends for at least 5, even better 10 years or more. This shows a commitment to returning value to shareholders. Take a look at companies like Johnson & Johnson, Coca-Cola, and Procter & Gamble. These are prime examples of companies with a strong history of dividend growth. By incorporating dividend growth stocks into your portfolio, you're essentially building a stream of passive income that has the potential to outpace inflation and grow your wealth over the long term. It's a strategy that can provide financial security and peace of mind. It's a strategy that stood the test of time and continues to be a favorite among seasoned investors. So start your research today and find those dividend growth gems that can help you build a prosperous future. All right, moving on to our next high-yield strategy, real estate investment trusts, or REITs for short. Real estate has always been a popular investment choice, and for good reason. It's a tangible asset with the potential for appreciation and rental income. But let's be real, buying and managing properties can be a real headache. That's where REITs come in. REITs are essentially companies that own, operate, or finance income-producing real estate. The beauty of REITs is that they allow you to invest in real estate without the hassle of being a landlord. Instead of buying a whole apartment building, you can buy shares of a REIT that owns a portfolio of properties. And the best part, REITs are legally required to distribute at least 90% of their taxable income to shareholders in the form of dividends. Now, just like with any investment, it's important to do your research and choose REITs that align with your investment goals and risk tolerance. Some REITs focus on specific sectors like residential, commercial, or healthcare, while others are more diversified. By incorporating REITs into your portfolio, you're not only diversifying your investments, but also tapping into a potentially lucrative source of passive income. Remember, everyone needs a place to live, work, and shop, making real estate a solid long-term investment. Talk about a passive income stream. With REITs, you can enjoy the benefits of real estate investment without the day-to-day management hassles. It's a win-win situation for those looking to grow their wealth steadily. All right, let's move on to our third high-yield strategy: high-yield bonds, sometimes referred to as junk bonds. Bonds in general are like loans that you give to a company or government. You lend them money for a set period, and in return, they pay you interest payments, known as coupons. High-yield bonds are simply bonds that offer higher interest rates compared to their more conservative counterparts, like government bonds. Now, you might be wondering, Why would a company offer higher interest rates on their bonds? Well, it's often because they come with a higher risk of default. These companies might have lower credit ratings or operate in industries that are considered riskier. But here's the thing, higher risk can also mean higher potential rewards. By investing in high-yield bonds, you're essentially taking on more risk in exchange for the potential to earn higher returns. It's all about finding that sweet spot between risk and reward. Diversification is also key when it comes to high-yield bonds. Don't put all your eggs in one basket. High-yield bonds can be a valuable addition to a well-diversified portfolio, especially if you're looking for higher potential returns. But remember, it's crucial to approach them with caution, do your research, and manage your risk effectively. Alright, let's move on to our fourth high-yield strategy, one that's been gaining a lot of traction in recent years, peer-to-peer lending, or P2P lending for short. This innovative approach to lending and borrowing has revolutionized the financial landscape, making it more accessible and efficient for everyone involved. P2P lending is all about connecting borrowers directly with lenders, cutting out the traditional middleman, the banks. This direct connection can lead to more personalized loan terms and a more streamlined process overall. Think of it like this. Instead of going to a bank for a loan, borrowers can go online to a P2P lending platform and request a loan from individual investors like you and me. This not only democratizes the lending process, but also opens up new opportunities for both parties. These platforms act as intermediaries, connecting borrowers with lenders and facilitating the entire loan process. They handle everything from credit checks to payment processing, making it easier for both sides to engage in the transaction. Because P2P lending platforms eliminate the overhead costs associated with traditional banks, they can offer more competitive interest rates to both borrowers and lenders. This means borrowers can get loans at lower rates, while lenders can enjoy higher returns on their investments. As an investor, you have the opportunity to earn interest rates that are often significantly higher than what you would get from a traditional savings account or CD. This can be a great way to grow your wealth over time. Plus, you get to choose which borrowers you want to lend to based on their creditworthiness and loan requests. This level of control allows you to tailor your investment strategy to your risk tolerance and financial goals. Now, just like with any investment, there are risks involved with P2P lending. It's crucial to understand these risks before diving in. The biggest risk is borrower default. If a borrower fails to repay their loan, you could lose your investment. Diversification is also key when it comes to P2P lending. By spreading your investments across multiple borrowers, you can mitigate the risk of any single borrower defaulting. Don't put all your eggs in one basket. Diversifying your investments can help protect your portfolio from significant losses. P2P lending can be a great way to earn potentially higher returns, while also helping individuals and small businesses access the funding they need. It's a win-win situation for both borrowers and lenders. But remember, it's important to do your research, carefully assess borrower creditworthiness, and diversify your investments to manage your risk effectively. By taking these steps, you can make the most out of your P2P lending experience. Alright, let's wrap things up with our fifth and final high-yield strategy: emerging market investments. Emerging markets refer to countries that are experiencing rapid economic growth and industrialization. Think countries like China, India, Brazil, and Mexico, just to name a few. These countries are often characterized by a growing middle class, increasing consumer spending, and significant investments in infrastructure and technology. While investing in emerging markets can be riskier than investing in developed markets, it also offers the potential for higher returns. As these countries continue to grow and develop, their stock markets tend to outperform those of developed nations. You can invest directly in the stocks of companies based in these countries, or you can invest in emerging market mutual funds or ETFs. Mutual funds and ETFs offer instant diversification, spreading your risk across a basket of stocks from different emerging markets. Emerging markets can be more volatile than developed markets, and there's always the risk of political instability, currency fluctuations, and regulatory changes that could impact your investments. For example, you might consider allocating a small portion of your portfolio, say 5 to 10%, to emerging market investments. Emerging markets can be an exciting and potentially lucrative addition to a well-diversified portfolio. But remember, it's important to approach them with caution, do your research, and manage your risk effectively. So, there you have it, folks. Our top 5 high-yield investment strategies for 2025. From dividend growth stocks and REITs to high-yield bonds, peer-to-peer lending, and emerging market investments, there's a strategy out there for every risk tolerance and investment goal. Remember, the key to successful investing is to do your research, diversify your portfolio, and invest for the long term. Don't get caught up in the hype or try to time the market. If you found this video helpful, be sure to give it a thumbs up, subscribe to the channel for more awesome content, and hit that notification bell so you don't miss out on future uploads. And as always, remember to consult with a financial advisor before making any investment decisions. Each strategy carries its own set of risks and rewards, so it's essential to conduct thorough research and consider your individual financial goals and risk tolerance. We hope this guide has provided valuable insights to help you navigate the investment landscape this year. If you found this information helpful, please like, subscribe, and share it with others who might benefit. This video is for informational purposes only and should not be considered financial advice.